let me tell you a story about a promise. It was a promise of safe, steady, and, let's be honest, massive income that lured in thousands of investors like a siren's song. Many of them were retirees just looking for a reliable paycheck from their life savings. The company was a household name, a blue-chip giant that had been paying dividends for over 100 years. It was dangling a juicy 7% dividend yield at a time when a savings account was basically a mattress gathering dust. It looked like a high-yield gold mine, a sure thing. But just a few months later, the trapdoor sprang open. The company announced it was slashing its dividend by nearly half. The stock price, which was already bleeding out, fell off a cliff. Investors who had piled in, chasing that spectacular yield, saw their income disappear overnight and their original investment get wiped out. This is a textbook dividend trap. It's a devastating mistake that can destroy a portfolio. But the worst part is, it's almost always avoidable. The warning signs were all there, flashing bright red like a railroad crossing signal. So today, we're going to do an autopsy on this financial disaster. We'll dissect the exact red flags that were ignored so you can learn to spot a sucker yield from a mile away and protect your own money from a similar fate. Because in dividend investing, the opportunities that look like beautiful flowers are often the most poisonous. The company at the center of this whole mess is one you definitely know, AT&T. For generations, AT&T was considered the classic widows and orphans stock, a financial lighthouse in a stormy market. It was a dividend aristocrat, a fancy title for companies that have increased their dividend for 25 straight years. It was the bedrock of countless retirement portfolios, a symbol of stability. Now, think back to the years leading up to 2022. The market was absolutely starved for yield. Interest rates were basically zero, and retirees were desperate for any income source to keep up with life. And then there was AT&T, a giant of American industry, offering a dividend yield that just kept climbing from 5% to 6% and eventually over 7%. If you were an income investor, this looked like an oasis in a financial desert. And honestly, the story was just so seductive. You could put your money in a huge, established company and get paid a 7% return every year, like clockwork. What could possibly go wrong? Well, the problem was that the numbers were telling a very different story. The company had spent the last decade on a massive acquisition spree, and the debt it collected was like a backpack it kept filling with rocks. It blew tens of billions on DirecTV and another $85 billion on Time Warner, trying to become a media and entertainment empire. The debt just piled up, hitting a staggering $200 billion. It's a number that's almost hard to comprehend. At the same time, its main telecom business was facing cutthroat competition, and that big media experiment, it was failing. The company pretty quickly realized its mistake and started to undo the disastrous deals. But the damage was done. The balance sheet was a wreck. Yet, while all this was happening, something strange was going on with the dividend yield. As the market punished the stock for its bad decisions, sending the share price lower and lower, the dividend yield just kept going up. This is the absolute heart of the dividend trap. The yield was rising not because AT&T was healthy, but because its stock price had a raging fever. Think of it this way. A high yield based on a falling price is like a patient's temperature soaring. It's not a sign they're getting warmer and healthier. It's a symptom that something is terribly wrong. But investors, blinded by that 7% number, just kept buying. They ignored the falling stock price, telling themselves it was a bargain, like buying a luxury car with a cracked engine block just because it's on sale. They ignored the mountain of debt. They ignored that the actual business was struggling. They just wanted that yield. Then, in early 2022, the inevitable happened. As part of its plan to spin off the Warner Media mess and clean up its finances, AT&T announced it was cutting its dividend from $2.08 per share to $1.11. That's a cut of almost 50%. The income stream thousands of people were counting on was sliced in half overnight, and the stock price plunged, locking in huge losses for everyone who'd been lured in by the trap. This wasn't some surprise event. It was the final, brutal confirmation of problems that had been building for years. The crazy part is, this whole disaster was totally predictable. The warning signs weren't buried in some obscure financial document. They were right out in the open for everyone to see. So, let's do the autopsy. We're going to break down the 3 critical red flags that signaled this dividend cut was not just possible, but pretty much guaranteed. The seductive but unsustainable yield. The first and most obvious red flag is the yield itself. Anytime you see a big, established company with a dividend yield soaring past 6%, 7%, or higher, your first reaction shouldn't be excitement. It should be the same suspicion you'd have if someone on a street corner offered you a Rolex for $50. A dividend yield that high is usually a sign of huge risk, not a generous company. Think about it logically. If a stock was truly safe and offered a guaranteed 7% return, every professional investor would be piling into it. It would be like a store giving away free filet mignon. The line would be around the block, and it would be gone instantly. That huge buying pressure would drive the stock price up, which, in turn, would push the dividend yield back down to a more normal level. When you see a yield that looks too good to be true, the market is betting the dividend is going to get cut. This is what we call a yield trap. The yield looks amazing, but it's a trap because it's based on a falling stock price. In AT&T's case, investors saw the stock drop from over $30 to the low 20s and thought, wow, the yield is over 7% now. What a steal. They didn't get that the falling price was a massive warning siren. It was the market screaming that the company's future was in trouble. Chasing that yield was like walking into a burning building because you heard the rent was cheap. The price is low for a reason, and in this case, the reason was the impending dividend collapse. The key lesson here is to flip your thinking. Don't see a super high yield as a gift. See it as a question. Ask why the yield is so high. Is the yield high because the stock price is in a nosedive? That's the classic signature of a dividend trap, and it's your signal to run away from the danger, not towards it. The sky-high payout ratio. If the high yield is the smoke, the payout ratio is the fire. This is probably the single most important number you can look at to check if a dividend is safe, and in AT&T's case, it was screaming danger. So, what is the payout ratio? Think of it like your personal budget. The company's profit is your monthly paycheck. The dividend is a big, fixed expense you've promised to pay. Like a fancy car payment, the payout ratio is the percentage of your paycheck that goes to that car payment. A healthy ratio is usually between 35 and 55%. This leaves plenty of cash left over for groceries, gas, and savings. But once a company is consistently paying out 80 or 90% of its profits, it's living on the edge. It means 90% of its paycheck is gone right away, leaving almost nothing for reinvesting, paying down debt, or handling an emergency. A ratio over 100% means it's funding that payment with credit cards. It's simply not sustainable. Now let's look at AT&T. In the years before the cut, its payout ratio was consistently in the danger zone, sometimes creeping towards or even over 100%. The company was essentially using credit cards to keep making a dividend payment it couldn't really afford. When you see a high payout ratio paired with a high dividend yield, you've got a toxic cocktail. The high yield is the market screaming that it's scared, and the high payout ratio is telling you why. The company has no financial wiggle room. This is why you always have to check the payout ratio. Don't just look at the yield. The yield is the glossy advertisement. The payout ratio is the price tag. And if that price tag indicates a company is paying out 90 or 100% of its profits, you're not looking at a safe investment. You're looking at a dividend living on borrowed time. Eroding fundamentals, stagnant growth and rising debt. And the final nail in the coffin is when the business itself starts to fall apart. A dividend is like an apple from a tree. You can't expect to keep getting healthy apples if the tree itself is sick and dying. The two most important vital signs to check are the company's growth and its debt. First, growth. A healthy company grows its earnings over time, and that growing profit is what fuels sustainable dividend growth. For AT&T, those huge acquisitions failed to deliver. Its earnings just weren't growing enough to support its massive dividend. But the even bigger story for AT&T was its debt. Think of it like your household finances again. Debt payments, like your mortgage, are non-negotiable. you have to pay the bank. Paying a dividend is more like giving your kids an allowance. It's optional. When money gets tight, what's the first thing you cut? The allowance. For a company, debt payments come first, always. Shareholders get what's left over. AT&T had piled up a mountain of debt, peaking at over $200 billion. This created a huge fixed expense that sucked up cash. When AT&T finally decided it had to change course and invest heavily in its future with 5G and fiber networks, it had a tough choice. Where was the money going to come from? It couldn't just keep borrowing. The only logical place to find the billions needed was to cut the dividend. That dividend wasn't just a shareholder payout. It was a ball and chain of about $8 billion a year. That was preventing the company's recovery. When you're looking at a dividend stock, you have to play detective. Look at revenue and earnings. Are they going up or down? Then look at the debt. Is it growing? If you see stagnant growth and rising debt, you're looking at a company running out of options, and the dividend will be first on the chopping block. Look, the AT&T story is a painful lesson, but it's a powerful one. It was a perfect storm of the three major red flags: a seductively high yield that was a symptom of a falling stock, a dangerously high payout ratio that left zero room for error, and a core business being crushed by stalled growth and a mountain of debt. Investors who ignored these signs paid a heavy, heavy price. But the good news is, now you know what to look for. You know that a high yield is a question, not an answer. You know to check the payout ratio to see if it's sustainable. And you know to look at the underlying business to see if the foundation is solid. True, safe dividend investing isn't about picking the shiniest apple from the barrel. It's about checking for deep bruises before you put it in your cart. Avoiding traps like this is the first step to building a truly resilient, income-generating portfolio. It's about choosing safety over seduction and solid fundamentals over flashy numbers. If you found this breakdown helpful and you want to learn more about how to find genuinely safe dividend stocks, make sure you subscribe. We post new videos every week, breaking down what you need to know to invest with confidence. And let me know in the comments below. Have you ever been tempted by a yield trap? What's the highest yield you've seen that made you suspicious? I read all the comments. Thanks for watching, and I'll see you in the next one.